SpaceX just went public, and in a single trading day, Elon Musk briefly became the richest person in recorded history before giving some of that back days later when the stock pulled back hard. Meanwhile, new Fed Chair Kevin Warsh just stepped onto the international stage at the ECB's forum in Sintra, telling the world plainly that inflation is still too high for comfort. And the S&P 500 just wrapped its strongest first half in years. Three different stories, one underlying question for your portfolio. What actually matters here, and what's just noise? Let's get into it. SpaceX's initial public offering was one of the largest in history. Shares opened well above their listing price, and the deal briefly pushed Elon Musk's net worth past the $1 trillion mark, a first for any individual, according to multiple outlets that track real-time wealth. For ordinary investors, this is also the first time you could actually buy a piece of a company built around orbital launches, satellite internet through Starlink, and a stated long-term ambition to eventually put people on Mars. That's a very different pitch than most IPOs. SpaceX isn't a software company chasing subscribers or an app trying to prove it can monetize attention. It's a company that already has real, physical infrastructure, rockets that fly on a regular schedule, a growing base of Starlink customers paying monthly for internet access, and government contract work that includes both NASA and defense-related launches. That combination, hard infrastructure, plus recurring subscription revenue, plus government backing, is part of why investors were willing to price the IPO so aggressively. But here's the catch. Nobody skips past fast enough. Less than 2 weeks after that trillionaire milestone, Musk's net worth dropped by tens of billions of dollars as SpaceX shares pulled back, and he lost the trillionaire title just as quickly as he gained it. That kind of swing tells you something important about how this stock is priced. A lot of that valuation is built on expectations for the next decade, not on current year cash flow. When a stock moves that violently in its first days of trading, it's a signal that the market hasn't settled on what this business is actually worth yet. It's also worth remembering that SpaceX isn't the first ambitious space company to test public markets. Several space-related companies went public through SPAC mergers a few years back, promising similarly big visions, and most of them badly underperformed once the reality of long development timelines and heavy capital spending met public market patience. That history doesn't mean SpaceX will follow the same path. Its operational track record with actual working rockets and paying customers is far more mature than those earlier ventures ever had. But it's the honest context for why some investors are cautious, even as headlines celebrate the IPO. Let's hear what was said. You just heard the headline version, but here's what's worth sitting with. SpaceX has an actual operational track record, regular Falcon 9 launches, a growing Starlink subscriber base, and government contract revenue that exists today, not just in a pitch deck. That's the bull case in a sentence. It's not a story company. It generates real, recurring revenue right now, and it has done so for years as a private company before ever going public. The bear case is just as real, though. A $1 trillion-plus valuation assumes SpaceX keeps executing close to flawlessly. No major Starship setbacks, no serious regulatory friction on Starlink rolling out internationally, and no meaningful erosion of its launch market share from newer competitors, whether that's Amazon's Kuiper satellite network or state-backed launch programs overseas. Add to that a lockup period before insiders and early investors can sell most of their shares, commonly reported at around a year in SpaceX's case, and you get a stock that can swing hard purely on sentiment, which is exactly what happened in the days right after the IPO, well before any real earnings data existed to judge the business by. There's also a psychological dimension here that's easy to underestimate. Once a company goes public, it inherits an entirely new audience. Quarterly earnings calls, sell-side analysts publishing rating changes, and a stock price that updates every second the market is open. Private companies can operate on multi-year timelines without that pressure. Public companies, even ones with a founder as dominant as Musk, eventually have to answer to that rhythm. For your portfolio, the honest framing is this. SpaceX is a real cash-generating business wrapped in a valuation that's pricing in a lot of future success. If you believe in the long arc of commercial space and satellite internet, and you can genuinely stomach real volatility, including the kind of swing we just saw in its first 2 weeks trading, that's the trade you're making. If you're looking for near-term stability or predictable earnings growth, this isn't that stock, at least not yet, and probably not for a while. New Fed Chair Kevin Warsh made his first major international appearance at the European Central Bank's annual forum in Sintra, Portugal, sharing the stage with global central bank leaders, including ECB President Christine Lagarde. This forum is one of the most closely watched events on the central banking calendar each year, precisely because it's one of the few times sitting central bankers speak candidly, side by side, about where the global economy actually stands. Warsh's message was direct. Inflation is still too high, and the Fed will not be comfortable until it's back near its long-standing 2% target. At the same time, he acknowledged that inflation expectations and some near-term risk measures have eased somewhat in recent weeks, a more balanced message than a purely hawkish or purely dovish read would suggest. He didn't promise imminent rate cuts, and he didn't threaten aggressive new hikes either. Warsh also went out of his way to emphasize something markets watch closely with any new Fed chair: central bank independence. Asked directly whether the Fed would hold the line on rates even if the White House preferred lower rates, he said the Fed has operated independently for a long time and intends to keep doing so. That's not a new position for a Fed chair to take. Every modern chair has said some version of it. But coming from someone in his first weeks in the role, it was a deliberate signal about how he intends to run the institution. Let's hear what was said. That's Kevin Warsh, in his own words, on the biggest global stage a Fed chair gets. Nothing here was a shock to markets, and that's arguably the entire point of a first international appearance like this. A new chair typically wants to project continuity and stability, not surprise anyone. He leaned heavily on the phrase data dependent, a term that's been part of Fed communication under multiple chairs going back years. Coming from someone this new to the role, though, it carries a bit more weight, because markets are still calibrating how literally to take his words versus his predecessors. For your portfolio, the practical read is straightforward. Don't expect the Fed to rush toward cutting rates just because markets or political voices want it to. Warsh's own comments suggest the bar for cuts remains genuinely data-driven, particularly around labor market strength and the pace at which underlying inflation actually cools, rather than just headline numbers moving temporarily in one direction. If upcoming jobs reports and inflation readings come in soft, that strengthens the case for the Fed to eventually ease. If they come in hot or mixed, expect Warsh and the rest of the committee to hold their ground, even under political pressure to do otherwise. It's worth remembering how differently various assets react to this kind of signal. Bond markets tend to move quickly and mechanically on any shift in rate cut expectations, since bond prices are directly tied to where investors think rates are headed. Equity markets react more to the growth implications. Higher for longer rates can weigh on high multiple growth stocks more than on steady cash-generating businesses. And currency markets watch the gap between how aggressive or patient different central banks sound relative to each other, since that gap drives capital flows globally. The bigger picture here, this was the first real test of how the Fed communicates under new leadership, and the honest takeaway is continuity, not a dramatic pivot in either direction. That's often exactly what a market recovering its footing wants to hear from a new Fed chair, even if it doesn't make for a dramatic headline. Here's a detour worth knowing, because it comes up in market and finance conversations more than you'd think: the Bobby Bonilla contract. Years ago, the retired baseball player agreed to defer a large chunk of his remaining salary in exchange for a fixed annual payment that the New York Mets are still sending him every year, decades later, landing every July. It's become something of a running joke in sports media, but underneath the joke, it's actually a clean, real-world case study in the trade-off between taking a lump sum today versus locking in guaranteed payments spread out over time. The lesson generalizes well beyond baseball, and it's worth taking seriously rather than treating as trivia. If Bonilla had instead taken his money up front at the time of the deal and simply invested it in a low-cost broad stock market index fund and left it alone, historical market returns over that stretch of decades suggest he likely would have come out meaningfully ahead. That's the standard argument in favor of the lump sum, assuming you have the discipline and long enough time horizon to let compounding actually work in your favor without panic selling along the way. But the annuity has real value too, and it's not just a punchline. It's guaranteed regardless of what happens to markets, to the team, or to the broader economy. It removes the risk of making a bad decision at exactly the wrong moment. For example, selling out of investments during a downturn out of fear, which is one of the most common and costly mistakes real investors make. That predictability is worth something in its own right, even when it isn't the mathematically optimal choice on paper. This same trade-off shows up constantly outside of sports contracts. Lottery winners face nearly the identical choice between a lump sum payout and an annuity. Structured legal settlements are built around the same logic. Even everyday decisions, taking a pension as one lump sum versus a monthly check for life, or accepting a buyout offer instead of continued salary, boil down to the same underlying question. Let's hear what was said. The deeper point here isn't really about baseball contracts at all. It's about how you personally weigh a certain modest outcome against an uncertain but likely larger one over time. And that exact same question shows up whenever you decide whether to lock in a bond yield instead of staying in equities, whether to take an early retirement buyout, or whether to hold cash on the sidelines instead of staying invested through a volatile stretch like the one SpaceX just went through in its first weeks of trading. There's no universally correct answer here. It depends on your actual time horizon, your temperament under stress, and how much you genuinely need that money to grow versus simply need it to be safe and predictable. Zoom out, and here's how these three stories actually connect for your portfolio. SpaceX's IPO shows investors are still willing to pay up for long-duration growth stories, even after a genuinely wild first stretch of trading. Warsh's remarks in Sintra show the Fed isn't in any hurry to validate that kind of risk-taking with rate cuts. Data-dependent effectively means the burden of proof still sits with the economy, not with the Fed, to justify simply holding steady. And the Bonilla story is a reminder that how you personally structure your own payouts and risk tolerance matters just as much as whatever the broader market is doing around you. Put together, the environment right now rewards patience and clear-eyed thinking over headline chasing. A stock like SpaceX can be a reasonable long-term position for investors who genuinely understand they're paying for optionality on a still largely unproven public track record. This is a growth bet, not a value stock, and not a safe stock. Meanwhile, with a new Fed chair signaling continuity rather than a dramatic shift in either direction, the safer assumption for now is that rate policy moves slowly and in response to real incoming data, not to market pressure or political preference. If you're holding highly valued growth names right now, it's worth asking yourself honestly whether you're genuinely comfortable with volatility like what SpaceX just showed in its first days of trading. Because that kind of swing can happen to any high-flying story stock the moment sentiment shifts, sometimes with very little new information actually changing. If you're sitting mostly in cash or short-duration assets right now, Warsh's comments suggest you're not obviously wrong to wait for more clarity before pushing further out on the risk curve. The through line across all three stories: don't let a single headline number, a trillion-dollar valuation, a hawkish-sounding soundbite, or a viral old baseball contract replace the actual unglamorous work of deciding what time horizon and risk tolerance you're genuinely investing for. That work doesn't make for a dramatic thumbnail, but it's the part that actually determines your outcome over years, not days. So, a historic IPO that briefly minted the world's first trillionaire and then gave some of it back within days. A new Fed chair who chose continuity over surprise on the biggest stage in global finance. And a decades-old baseball contract that's still quietly teaching one of the most useful lessons in personal finance. Different stories, same underlying question. Are you investing for the headline or for the math? Drop your take in the comments. Are you buying into stories like SpaceX at these valuations or waiting on the sidelines for more clarity? Subscribe for more of this every week. Tomorrow, we'll look at what's actually moving in this week's jobs data and why it may matter more to your portfolio than any single Fed soundbite.